What's up, everybody? Welcome to another episode of the Stock Bros podcast. My name is Tony. So I got another great episode for you today, and we are going to talk about one of the most feared words in the world of investing, or really in life, and that's taxes. So before we get into taxes, please subscribe, leave a like, leave a comment, and let me know what you think of the video. And if you have any questions, let me know, and I'll try to help answer them. So let's talk about taxes. This is going to be Taxes 101, taxes for beginners. So you got to start with the term capital gains tax, right? Capital gains are profits from a sale of your investment. So it can be stocks, bonds, real estate, etc. And the key word here is profits. You only pay taxes on your profits. You only pay taxes on your profits. So an example would be if you were investing $1,000 into a stock and it blows up to $2,000 and that's your total return, and you decide you want to sell it, right? You're up $1,000. You do not pay taxes on the full $2,000. You only pay taxes on your profits. So you would only pay taxes on $1,000. You only need to pay taxes when you sell an investment. You do not pay taxes on unrealized gains. So you will need to pay taxes on dividends because those are realized gains. Unrealized gains are profits that you've made, but you haven't sold yet. So gains can constantly fluctuate up and down and with the ebbs and flow of the market, and you don't pay taxes on gains that you don't sell. So if you're up $1,000 on something in your account, you don't need to claim that at the end of the year until you sell it. As soon as you sell, you are now responsible for paying capital gains tax. A lot of people think that if you sell a stock and you leave the money in a brokerage account and you don't put the money in your bank account, you're not going to owe any taxes. This is completely false. You will owe taxes as soon as you sell an investment. It doesn't matter if you reinvest the money. It doesn't matter if you let the money sit in a brokerage money market account. It doesn't matter if you transfer the money to your bank account. It doesn't even matter if you quickly reinvest the money into something immediate, or you do it right away that day. You still owe taxes, and you will be responsible for claiming these taxes at the end of the year. And I will get into how you can do that a little bit later on in this video. So, capital gains tax. Let's talk about the two forms of capital gains tax. So you have short-term capital gains tax and you have long-term capital gains tax. So let's start with short-term capital gains tax. Short-term capital gains tax is when you sell an asset in under 1 year of owning the asset. So you will have to pay ordinary income tax. So short-term capital gains equals ordinary income tax bracket. So depending on what your income is, the tax brackets are 10%, 12%, 22%, 24%, 32%, 35%, or 37%. It really all depends on how much money you make and what you qualify for or what bracket you're in. So long-term capital gains tax is the reason why you want to hold your investments. You don't want to sell them early. And this is actually, when you're a day trader or a swing trader, you have to pay short-term capital gains tax. So it's a big disadvantage of being a day trader. Long-term investors like myself that buy and hold, we're going to qualify for long-term capital gains. Now, long-term capital gains is when you hold an asset for a year or more before you sell the asset. This is how you qualify. So the tax brackets for long-term gains are 10%, 15%, and the very top is 20%. So this is amazing. You could save a lot of money if you just hold your investment for a year or more. So it's very beneficial to hold your stocks. Long-term capital gains tax rates, you pay nothing if you make $40,400 or less. You pay 15% on your gains if you make $40,000 to about $445,000. So that's a great deal. And 20% if you make $445,000 and up. So it's very beneficial to hold long term. And let's get into, that's capital gains. Let's get into losses, capital losses. So a lot of people ask, can you write off investment losses? The answer is yes, but you can only write off $3,000 per year. Now, this isn't a write-off. You don't get the $3,000 back in your taxes. What they do is they lower your taxable income by $3,000. So if you make $40,000 a year, they will lower your taxable income to $37,000 a year. So you're not getting all of that money back. You're just getting a little bit of a break on what you may owe and what your full taxable income is. So the next tax loss thing that you need to know about is called a wash sale. A wash sale is when you sell at a loss and then you buy the same stock back within 30 days of selling at a loss. When you do this, you no longer qualify to write off your loss. So you don't want to sell an investment at a loss and then buy it back again within 30 days. You want to try to avoid this. The IRS cracks down on this and they won't allow you to write off that loss. Now, your brokerage will actually give you a tax form right before filing season. So usually it's at the end of January, the beginning of February. And this tax form will give you your capital gains, your losses, your dividends, and any other type of interest you may have accrued from your investments. It's really easy. There's no need to panic. We're going to make taxes simple right now. All you need to do for most tax firms, what you can do is you can upload these forms that you get from your brokerages right into your tax account. It's really easy to do it. You can do it on TurboTax, H&R Block. I actually did my taxes on Credit Karma this year. I didn't upload the forms, but the forms are really easy to read. You just write down the numbers in each box. It's really easy, guys. Credit Karma and all these tax firms will guide you through it. Very simple. And that's how you can do your taxes. You don't need to keep track of everything. You can if you want to, as a way to double check, but your brokerage firm will keep track of your capital gains, your capital losses, your dividends, all that stuff, and they will give you the appropriate forms that you need to file your taxes for that season. So one suggestion I would like to add is when you sell an investment at a profit and you have capital gains on it, you should automatically, if you sell and you make $1,000, you should automatically put away the percentage that you're going to have to pay in taxes into a savings account and don't touch it and just hang on to it, out of sight, out of mind. So that way when tax season comes along, you can just take that money in that account and pay your taxes with it and you don't have to worry about it. So let's talk about the ways that you can save on taxes. And there's a couple. The first one is pretty obvious. You can use a tax advantage account like a 401k, an IRA, a 529 college savings account for your kids. You can use a Roth IRA. Now, Roth IRA is probably the most beneficial one because those are tax-free and you don't have to pay taxes on any investments. And if you sell, you don't have to pay taxes. Now, the thing is, there are a lot of different rules with different Roth IRAs. So you're going to want to check with your brokerage and ask them about the rules. But typically Roth IRAs are the best way to go, especially if you're saving for retirement. And sometimes with Roth IRAs, they let you withdraw the money early. You don't have to wait till you hit 59 and a half or whatever the age is. So that's something that's very beneficial. You should definitely look into that. Another thing you can do is you can carry over your losses. So like I said before, you can claim up to $3,000 per year. The IRS actually lets you carry over additional losses from the prior year to the following year. So if you lost $6,000, you can carry that extra $3,000 over for the following year. And another thing you can consider, and my last suggestion would be to use a robo-advisor, because robo-advisors manage your investments for you automatically, and they often have strategies where they save you money with taxes, including like tax harvesting strategies. And they also are really good at selling losing investments and offsetting those in the gains into, what they do is they take the gains from your winning investments and they'll throw them into your losing investments and help offset your gains. And it's a good way to rebalance your portfolio as well. And I will be doing another episode on rebalancing your portfolio, so stay tuned for that. So I think that just about covers the Tax 101 class for today. Hopefully this helped you understand taxes a little bit better. And also, there's nothing to fear when it comes to taxes. You just need to know what your tax rates are, and you need to be prepared. It's as simple as that. And a robo-advisor that you can use to help you out is something like Acorns. And I have a link for Acorns in the video description. I love Acorns. It's a great way to invest. You micro invest with as little as $5 a time. They take your roundups from purchases and they invest it into well-balanced, diversified portfolios with ETFs. Check it out. If you have any questions about it, let me know. I'll help you out. And I also have a link for Public for those of you that don't have access to fractional shares with your brokerage account. Public gives you access to fractional shares, ETFs, for as little, you could buy them for as little as $1 if you want to. All right, so thanks for watching. I appreciate it. And until next time, see you later.